It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Avril with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Let's get your top stories today, plural. We're looking at markets right now. Stocks, as you can see on the benchmark basis, under pressure. That's after this tech-led rally on Wall Street falters. You have gold, of course, which is the big story as well, extending its gains following its best day in 6 months, while the dollar sinks to a 2-month low.
Big insurers and banks are set to drop in Hong Kong on reports that Beijing plans to expand its personal income tax to cover policies sold in the financial hub.
And China restricts the export of drones to the U.S. as part of a barrage of measures in retaliation against recent U.S. curbs.
So looking at the market reaction an hour into the Asian session, we're seeing the memory names getting hit, thanks to SanDisk, right? That disappointment. Yeah. And thankfully, I think, investor focus is now shifting to the Hang Seng Tech, the internet platform names, as they look like they have a better shot of perhaps monetizing all that AI investment. And this is coming at a time, maybe we see a rotation away from Hang Seng Financials as well, given this crackdown that we're seeing, right?
It's certainly going to intensify the rotation out of financials, which have done well. And of course, the news flow certainly is, to your point, supportive of that. And I think what's interesting to your point, too, is you are getting the usual tailwinds, but you're not getting the usual effect in markets, right? So you have tighter spreads, you have lower oil prices, you have a softer dollar, but yet you have a benchmark which is down about 1%, let's call it that. And I guess to your point, right, the AI story tied to the U.S. seems to be the drag today. And I think we'll see that, right? So let's have a look at where we are as far as markets go, because, we're looking at the session today. Again, softness in most parts of the equity complex. It might be different in Hong Kong and within Hong Kong, which we'll get to in a moment there. But yes, in case you're joining us now over the first time in 24 hours, that's right. Gold is closer to 45 than we are to 4. There had been a decent pop overnight going into this morning, which we are extending right now. Right. Speaking of gold, a couple of miners to tell you about. You have one, of course, in Oz. You have earnings coming through out of DBS. Hon Hai is indicative of the AI story, out with monthly sales up 50%, I think, was what the company reported for July. And, of course, SK Hynix, to the point Avril just made, is indicative of the memory drag we're getting today. Right, A50 futures coming up on your screens. We should have dollar Hong Kong and dollar China on your screens. We don't have dollar Hong Kong. I was going to talk about that. Anyway, we can talk about that later. But yes, at 674.66, we are at the strongest level here on offshore and onshore since about early of 23.
We're watching, of course, the insurers when markets open in a few minutes, just after the banks and insurers exposed to mainland Chinese wealth flows. We already saw the market reaction in London following the Tyson report that Beijing was closing a key tax loophole for Hong Kong insurance policies. For more, we're joined by our North Asia Chief Correspondent Stephen Engel and Bloomberg Intelligence Asia Pacific Insurance Analyst Stephen Lam. Steve, let's start with you. I mean, what do we know so far about the extent of this potential crackdown?
Well, we do know that Beijing has been trying to increase, obviously, its oversight of cross-border wealth and also improve tax transparency. And these reports are coming out of Caixin Global, which is a fairly independent news organization in China. And they're looking at how the authorities are potentially going to be adding dividends and returns from these tax policies that so many mainland Chinese, when they come to Hong Kong, for example, buy up these policies. And that's been a big source of growth for many banks and also insurance companies. AIA, Prudential, HSBC have been increasingly relying on selling these policies. But now Caixin Global is essentially saying, as another step in Beijing's efforts to do what I just said, basically strengthen oversight of cross-border wealth, improve tax transparency, they're going to be adding these returns to individuals' personal tax returns and statements and scrutiny. Now, again, these kind of returns in the past have been liable to tax by authorities, but it's been very hard to collect that tax, essentially because of the lack of data transparency or data availability. So I guess the question to Stephen is going to be, how have they increased that transparency and their ability to enforce that?
Well, okay, let's put that question to you, from Stephen to Stephen.
So the situation is very complex. Let's put it this way. I think it's one of the most, to put things into perspective, right? This is by far the hardest clampdown that I've seen at least in a decade. Last time we had something like this was back in 2015, 2016 on the UnionPay swiping card. Steve probably remember about that. So that's actually on the actual money movement side, right? So to put things into perspective, as of now, roughly speaking, you can say mainland customers account for about, say, between 30 to 50%, give or take, right, in terms of the total new business in Hong Kong for life insurance companies. And this range is very wide. You know, some insurance companies like AIA, Prudential is higher on that scale. Maybe 50% of that business is from mainland, right? And then a little bit less for the others, probably a little bit lower, right? But we ran some numbers. So, for example, right, if you shave, let's say, every 10% off that, what they call MCV, mainland Chinese visitors segment, right, the impact on the whole company ranges between 2 to 3%, right? That's for this year. Now, of course, the question is, you know, can this apply to existing policies? Is it just affecting new policies? Will customers, because of higher friction costs, will surrender the policy and buy stuff in mainland, right? So we can get to those, but in effect, it is significant. I don't want to water this down too much. Let's put it this way, right? We need to be extremely cautious about this. But my personal opinion to that is, buying insurance policy is not a tax evasion, to my knowledge, right? The purpose is not to evade tax. If the argument of putting this tax on offshore insurance policies, then what about the onshore policies? That would be the first question I ask myself, right? At the moment, insurance policies returns or the payout are not taxed. That's where we're at right now. So we can debate whole day why China is doing this, right? But clearly, you know, we need to look at the facts, right? What can they actually do, and what is actually going to impact, right?
Right.
Yeah.
That is our question that we're trying to figure out, because, again, they're trying to plug many different loopholes and many different ways. I mean, you're saying it's not tax evasion, but clearly the Chinese authorities want to bridge this yawning budget deficit. They also want to stem what they see to be excessive or illicit cross-border flows. We've seen a number of different steps. We've seen the crackdown on the brokerages. We've seen sort of an attempt to crack down on trust structures that have been popular with the ultra-wealthy. I've had lunch with a senior banker here in Hong Kong who brought me to lunch to ask me what's going on. How do we deal with this? Because they're trying to figure this out. And I agree with you, Stephen. This is serious. When, you know, wealth management has been such a big part of the bank's profits. You mentioned some of those numbers of the banks. HSBC's fastest growing wealth business with fee income, these life insurance policies, fee income up 21% in the second half. And Hong Kong annual new premiums up 26% in the first half. So it's been extremely important. And one anecdote I got from other bankers is like, why is the financial secretary, Paul Chan, trumpeting? Because he's trumpeting Hong Kong's now the wealth capital of the world, surpassing the beginning part of this year, Switzerland. Shh. You know, that's just, sort of warranting excess scrutiny. It's, of course, something the Hong Kong government wants to trumpet and say, hey, this is good, Hong Kong's back. But at the same time, it's putting a lot of pressure on insurance companies and banks for their excessive or for increased oversight.
Yeah, Stephen, to your point, right, can I just add one point? If we look in the longer term, right, you can also debate why it's 20%, why not higher, why not lower, right? But if it's really at 20%, I'm pretty sure that the returns that the customers are making from Hong Kong is still much more competitive than what you get onshore. Okay, so it is a frictional cost, but it's not a destroyer to all of the demand. So people, we need to recalibrate, what exactly they're looking for, right? And by all means, to me, this is not really for Chinese authorities to increase their revenue. Let's face it. You're taxing on the return. You're not taxing, it's not an estate tax, right? So that amount is small, right, to my mind. And actually, even if you say that, we want to bring some business back from Hong Kong to mainland, for example, our number shows that all the Hong Kong policies, all the people that bought policies in Hong Kong, it's only like low single digits equivalent to the mainland pie. So they're not trying to bring business back to mainland. It's not going to move the needle. For guys like, AIA, 20% of the business is in mainland China anyway. So they can effectively recapture some of that, right? Well, along with Prudential and some other people.
Okay, so here's my question to you, Stephen. We did get a market reaction. It looks like we're going to get declines again here today. Across these names, who do you think is the most vulnerable to this? Net, of course, you mentioned, of course, they do have business either side of the border. And my question to you, Steve, is, are we overthinking the insurance side of this? And is this simply another exercise in terms of curbing illicit flows? Let me start with you.
Okay. So purely from the main impact, I would say FWD and Prudential are the bigger impact because they have less mainland exposure, the actual onshore mainland exposure, right? Now, if you look at just the Hong Kong business, by far, HSBC is the most exposed, for sure, right? But it get watered down when it chained up to the group, right? Because the whole valuation of the life insurance companies is probably like, less than 10% of the whole group valuation.
Of HSBC.
Right.
But how much of this is also just authorities sending a message? We saw it in June as well. This came out, the insurance and the banks here all tumbled because there was talk that authorities were asking banks to not open new bank accounts to mainland Chinese. And that sent a message to the market that this is possibly the beginning of an even larger and wider crackdown. And that is the question I think bankers are asking right now. Wouldn't you agree?
I mean, I don't want to open another can of worms.
Yeah, well,
but you start with insurance policy. Next question is, what about bank deposits? What about you can buy a Chanel bag or LV bag outside? Do you have to get an extra tax? I'm not trying to exaggerate things here, but it does give people that kind of concern, like what's going on here.
Okay, well, I think we've opened up more questions than we've had answers for, but I think that's kind of the point. Fantastic, guys. Thank you so much. Stephen Engel there and Stephen Lam, of course, on the news and analysis front as well. And, coming up is, in fact, perhaps no better perspective on this from a wealth manager. Why not, right? So we'll see how this is permeating in the wealth management space. This is more on the investment strategy side. Eva Lee joins us in a couple of minutes here to talk us through the opportunities within the equity markets and given the rotation we've seen recently. We're counting down to the open of trade in mainland China and here in Hong Kong. Futures are coming up bottom of your screens. Within this, of course, we've highlighted financials are one to watch. We are indicated lower there. What happens, though, to the tech tailwinds we're seeing across the region? The opening bell 17 minutes away. You're watching The China Show. Good morning and welcome back. 15 minutes away from the opening bell. What we've seen is, and just to hopefully highlight is, I know it's not that clear in terms of the font size, but what we're showing is sector rotation and what's gaining momentum, what's not, what's losing momentum within MSCI China over the last 4 weeks. Effectively, where you want to be is in this quadrant where you are outperforming the index and you're also seeing some momentum. And the changes we've seen in the last week or so is healthcare has actually come from underperforming to now outperforming and gaining momentum. That's the green bit you see right here. Tencent and communication services are inching their way from one where you're underperforming, you have some momentum into perhaps more market leadership, and you're getting financials coming down a little bit, and you're also getting some of the hardware plays, which is interesting, also coming down. That's RRG Go on your Bloomberg terminal, just to get you a sense of how sector churn is playing out. Now, the reason I bring this up is you have commercial services. It's the Hang Seng Tech Index that's actually outperformed most benchmarks, right? And while you are still seeing a downtrend, it's tested that trend line multiple times. We actually have seen an early breakout, just to qualify that, very recently. And does this then underscore this rotation, this bid for internet that's come back in a very visible way, Avril?
Yeah, and that is actually one of the, investment cases that our next guest is making. She remains bullish on Chinese tech, recently raising the internet sector to second in a China tech pecking order, up from fifth previously. Let's bring in Eva Lee, head of Greater China Equities at UBS Global Wealth Management, Chief Investment Officer. So, Eva, Dave has just laid out, some of the market moves that we're seeing, but what is the investment case you're making? Are we in the early innings of that rotation back into Chinese internet platform names?
I think that already has, happened. I'm not saying that already done, but it's just happening. We noted that, the foundation models, we are now have, I think, 3 different companies rolling out their latest version.
Yes.
Sort of proving that, China AI were not too far behind, the global peers. First thing. Second thing, it's, of course, the overall e-commerce space. People have been feared about the subsidies they have given to the food delivery. Companies coming and say, hey, we are doing, sort of reducing the subsidy. So the worst in terms of earnings, momentum, or the subsidies, the most that it's already behind us. So that's the 2 things that, sort of lifting the sentiment of China tech.
Okay.
Yeah.
Okay, China tech's a big bucket with many different parts, right? And I think internet, you've raised that from 5th to 2nd. Semis, I think, are still number 1 for you.
Correct.
Could you help differentiate how you're looking at Chinese? What's the best way to play Chinese tech or Chinese AI at this point, given that information?
Let me bring you from what global sort of looking at AI, right? At the moment, everyone focusing on monetization. And I think that will also be the case for China. So whoever be able to deliver like crowd growth better than people expect, margin better, these are the companies that people will focus on. And on top of that, some of them even have their own chips, AI chips that they already developed. They're able to sell it to other companies, exactly what US has been doing. And that company will sort of be more supported in terms of valuation. So now we're talking about show me the money. Like you spend a lot already. China might not be the case, but they do spend as well, right? So now who are about able to capture, the most benefit out of these sort of spending? I think that's how you sort of pick the winners versus the average.
So how much catch-up do you think is possible on the Hang Seng Tech? Because you look at EPS and other metrics, things still look quite subdued.
Well, we have to look at both sides. First, the margins of the cloud in China is a lot lower than that of US. So we cannot say that Chinese valuations will be, matching that, because we're talking about US over 30%. China, like teens margins. Right. It's already a breakthrough compared to 9% in the past. But having said that, when you look at its own trajectory, I think at the moment we're talking about just slightly above average. So we're not yet at a level that's very worrying. We're talking about close to like high teens versus the earnings that they're going to deliver. We're talking about, close to 15 to 20% on a 3-year CAGR basis. I think it's still very reasonable. So I don't worry too much about valuation, but be realistic about how much they can narrow the gap against the US
Can you
peers.
help us also understand some of the broader dynamics at play? Because we are seeing today the Kospi, right, getting hard hit. And this is in a week where maybe we saw a bit of optimism surrounding the memory, the momentum coming back. How are investors then allocating towards China with that in mind? And then within China as well, what are you seeing in terms of, the crackdown you're seeing on some of the tax issues? Does that also affect the Hang Seng financial related stocks and then drive things further into Hang Seng Tech?
So within the entire AI space, we regionally people very much into this certain memory chips in particular. But if you look at the past, memory chips, sort of the bull market never lasts more than 12 months. This round is very special because you need a lot and then the market doesn't have enough. So you have a substantial and growing demand and then supply, it takes time to catch up, but it will catch up eventually, right? And it's not just from Korea, maybe China is doing some memory chips as well. So the situation is moving. So people need to monitor that and do not look at E because the E can disappear or lowered in 2 to 3 years time. I think that's very important when you look at PE, all right, sustainability of the earnings. Apart from that, when you look at the entire monetization side, I talk about foundation model. Now almost every week we have 1 or 2 new models coming through. So the competition is crazy. So when you sort of analyze the situation, we need to look at the competition's level, whether one will be able to dominate the market share, and then you can pick your stock. It's like, oh, I know that they have the ecosystem. The ecosystem will not disappear. The people already rely on the chat, the payment. They already develop a habit. It's very tough for them to move. So I think this is also very important to understand. Now we're talking about AI monetization. Who able to capture this, become a recurring earnings?
If investors can't be bothered with all that, if that's just a headache, picking the winners, are there other sectors that seem to be cleaner cut, income? There's been a return to cyclicals and value recently. Fixed income, I don't know. Like, what are we missing as we obsess over this?
Recently, we have talked about this yield, seeking for yield. Banks already have done very well. We start to see a bit of rotation, as you showed earlier, right? A bit of rotation. Domestic insurance companies, should be also gaining this people seeking to invest, not necessarily to equity market all the way, right? They might seek for some investment product over by insurance companies, domestic insurance companies. So that is going to do well. Apart from that, some of the SOE actually started to do buyback. And look at the share price. It really reflects that. So corporate governance, not just in China, I think also in Japan, a few Singapore, we have some regions that these are even on a higher, US 10-year yields at 4.6 is not low, but people still, sort of think about what sort of a positive carry I can get from the dividend stocks. I think that's another element. Lastly, going overseas, we have been seeing certain sectors really already done a lot of work in the past in terms of breaking into the international channel. So they are able to gain margins because China, the evolution, they're really creating very efficient margins within the space. So when they expand, the goods are very competitive in the international market.
Eva Lee, thank you so much for that and the perspective really there. Head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. If it is dividend yield you want, that dividend yield just picked up this massive pullback we're seeing across financials today. HSBC, want to watch, of course, among others. Lots more ahead. This is Bloomberg.
Right, we're tracking that early market reaction to China's crackdown, the tax-related front when it comes to insurers in particular. You're seeing already the drag coming through from the likes of Prudential. We'll continue tracking that.
Good morning and welcome back. For anyone that was waiting for a dip to buy in this red-hot financials rally we're seeing globally and, of course, locally in this part of the world, guess what? There is a very sharp dip to buy if that is something that would float your boat today.
Yeah, buy the dip if you're brave. Hey, some of the other finance stocks around the region, I mean, you look at DBS earnings today, right? Yes. There was that beat. The stock in general has been doing quite well, maybe a bit of a pullback in recent time. But of course, this is against the backdrop of earnings, right?
Japanese financials have done well.
Japanese financials, we're seeing, I think, the likes of Sumitomo, MUFG, they're the ones that are leading the pack today. But there's also that rotation into Hang Seng Tech. Maybe we see a bit more of that today as well, as Eva Lee was just highlighting. when you look at what this means for the AI hardware trade, I think it's a bit tricky as well. And you're seeing, I guess, the early indications on the memory slump. From what you saw in Korea, in Japan, that seems to be translating into chunks in memories pressure as well. That's dragging the Chinex and CSI 300. Of course, you're looking at that down day as well. Take a look at what we're seeing in Hong Kong stocks. If we can flip the board, take you there as well. On a day where maybe the focus is a little bit off from these Chinese internet stocks. We did see a bit of that rotation into them, but that pressure still seems to be coming for tech stocks. Okay, if you look at Meituan, you're seeing it flat along with the likes of Xiaomi as well. So maybe they need to see a bit more in the way of AI monetization when it comes to that confidence in the Chinese internet platform names. Because also this is coming on the day where maybe investors are digesting this tax crackdown, right? So maybe that's causing some skittishness. I don't know. Take a look at what the insurers are doing. Take a look at how, we already saw the board, take a look at how Prudential, you're seeing that, right? This is exactly what Steve highlighted earlier in terms of the companies that could be the most exposed. So you're seeing that playing out in market trade as well. We got to talk about some of the southbound connect inclusions, the likes of Minimax, Luxshare, CCTC. These are the counters that we're watching. Okay, Minimax. Take a look at the Model AI developer. That seems to be the one that is flying in trade today. Going the other direction, the Chinese solar stocks. Of course, we did hear from the Trump administration or some reporting related to moves that they are considering in terms of tariffs and, a price floor when it comes to materials that go into chips, that go into solar panels. We'll talk a bit more about that. But in the meantime, we're talking about Chinese AI as well, Dave.
Yes, internet. And I think this time yesterday we were speaking with Goldman Sachs, Ronald Kung, and, the best way to play the AI story, which perhaps is still playing out somewhat today with the internet. And I think Minimax was up on that inclusion of stock. I mean, it's worth just before we talk about what Ronald Kung said, just to note there too, right, that this inclusion on the Stock Connect seems to be benefiting ones where you only have one listing in Hong Kong, because at Luxshare, for example, I think is listed in both. So it's almost academic that you could buy the other when the other one is available. Anyway, Ronald Kung on how to play the Chinese AI space. Have a look.
We believe that growth in tokens and the capex uplift that we're anticipating for the second half of this year as domestic chip supply increases, cloud and data centers are our top preferred subsector, and that's where the hyperscalers, which are the internet mega caps, are best positioned with strong cash flows, the ability to fund the capex and grow a cloud business, where we're estimating 45% growth for Alibaba cloud business in the June quarter that we anticipate. So these are the key numbers that are actually driving the growth is driven by the token.
In fact, we have a piece out on that today on the Bloomberg terminal. You can check that out. To unpack that piece for us, these internet giants back in focus today and the quick progress on the back of perhaps being future beneficiaries of low-cost AI. Sunny Bangya is with us right now, our equity strategist out of Sydney. The open source conversations has been around for several weeks, but we've only started to see this show up in markets. Talk us through what implications we are really seeing for AI labs and some of the platform companies, Sunny.
Thank you. Yes, so we've had a big move towards open source over the last month. And prior to that, it was all about the leading frontier labs, how they were dominating token usage and making an incremental 80 to 90% margin on each token. And that they were going to be the winners of this AI revolution. And that sort of narrative's changed over the last 6 to 8 weeks, as you've seen a whole host of Chinese models come out and dominate the middle to bottom end of the curve when it comes to AI capability and model capability. And that's been quite a positive development and a change of narrative from the frontier labs winning to perhaps now AI diffusing across more tech sectors, particularly Chinese internet, Chinese hyperscalers, and also global internet and global hyperscalers. And in the US, in the last week, we've seen an improvement in operating cash flows out of US tech stocks in the cloud space, which is boding well for the funding commitments that they're going to have over the next 1 to 2 years to build out the AI tech space.
Talk to us about longer term, perhaps. How do the winners and losers shake out? Because, I mean, it's not a straight line to these things. Yes, we are seeing a bit more confidence in the internet platform names, particularly in China. But, you know, Hang Seng Tech is facing that pressure today.
Yeah, absolutely. I mean, this is still very much early developments in terms of these open source models and how they will proliferate. It is unequivocally very positive for the users of the open source models. So software companies around the world, hyperscalers, using it, diffusing it into their technology. It's very positive, but we're still early in that development. There's still politics that needs to come out of it. There's been two sides, whether these models from China should be banned. There's been on the other side where Jensen Huang's led the effort to promote open source models. So we're really early, and we want to see over the next 1 to 2 quarters companies talking about how they are using open source models to lower costs and to increase engagement. That will really then take this to the next leg. And the early signs are really coming out of the hyperscalers in the US that have spoken very openly in earnings calls about how this is benefiting their businesses and lifting growth.
Okay, and the risk of politics, which you alluded to just now.
Of course, so obviously there's a big technology race happening between the US and China, and DeepSeek put the China AI labs on the map, and I think Kimi K3 had that same effect. The Kimi K3 was a much larger political shock because it obviously showed that China is not only catching up in terms of quality of model, but also willing to put more expensive models out there, more capable models out there. And now there's like battle lines being drawn in terms of should the US companies allow this to occur. At the moment, I think the view from majority of the US tech space is that let competition win. Let these models proliferate into the US, safeguard them, fine-tune them, host them on US cloud services for security and safety, and then see how the user base adopts them over time. So it will be a space to closely watch. And the noise is obviously going back and forth with the drone retaliation overnight from the day before. You had US drafting some legislation or planning to draft some legislation on Chinese optical companies. So obviously this is just going to be a space to watch as these two countries that are really fighting against each other in this AI race over the next year or two.
Yep. Sunny, thank you for talking us through this. Bloomberg equity strategist Sunny Bhangia for us. And I suppose continuing in that same vein in competition between the US and China, let's also take a look at how some of these drone stocks are faring. You're seeing a bit of green on the screen, and this is coming against the backdrop of Beijing tightening export controls on drones as part of a series of retaliatory action against Washington. And this comes as President Trump is said to be preparing to impose levies of at least 15% and minimum prices on imported polysilicon. Bloomberg's China correspondent Mimi Lo joins us now with more. So walk us through the measures that Beijing is taking.
Yeah, so we have seen how China has been pretty restrained so far after the series of measures that US has taken, right, when it comes to those import curbs on everything from power inverters to robots to routers. And now all the retaliatory actions are coming at one go. It's a package of measures that China is unleashing, including export controls on drones and their components. Now, remember, the US was the first to impose import controls on foreign-made drones, but they apply to future models that are not yet approved. China is now taking it a step further to impose controls on even existing models that have already been approved. So this could further choke that supply chain constraint that the US is facing. China is also conducting its very first foreign trade national security probe into copiers and printers. And it's also sanctioning some 6 entities involved in the Xinjiang-related sanctions. And it's also sanctioning a company, a testing lab called Compliance Testing, which helps the US FCC to impose regulations. And the Commerce Ministry says it's halting any factory inspections by US regulatory bodies. So a series of measures here, but I think one key message to take away from the Commerce Ministry was that they highlighted that these countermeasures are very restrained, and they still value the very hard-won stability between US and China, and they're urging the US to withdraw the related measures and to come back to the negotiating table to basically resolve this in a peaceful manner through consultation.
What about these levies on polysilicon, which is counterintuitive, the move we saw in U.S. solar stocks as well? What's going on? And I think we're also seeing a similar move in Hong Kong today.
Yeah, so this is according to what sources are telling Bloomberg. The Trump administration is considering imposing a tariff of potentially at 15% plus minimum price floors on polysilicon as well as their derivative products. So things like solar modules, silicon wafers could be affected. Now, 15% is lower than what some analysts were anticipating. They were expecting 25 to 35%. So technically, it's a good thing. But the reason why some of these solar stocks in the U.S. is falling is because many of them already have limited production capacity in the U.S. They rely on imported polysilicon, and the tariffs obviously is going to raise the cost of production, which eventually might have to be passed on to consumers. So that's not a great thing. The Trump administration is said to be planning some sort of temporary offset program for these companies on the condition that they have some level of capital investment in the U.S. to help reshore production. But again, you can imagine this is quite controversial at a time where, the U.S. is heading into midterms and the U.S. is already grappling with inflation as well.
Or maybe partly because of that, too. Min Min, thank you so much. Min Min Lo, our China correspondent there. Just look at markets right now. If the color of the attire hasn't given away, of course, the direction of travel across these markets, here's an actual look at the color of markets as we go into the first 12 minutes of the cash market trade. We'll take a short break. We'll be back.
Now, among the stories we've been tracking as well, the issue related to cybersecurity, and this is after weeks of market turbulence. Hedge funds now confronting the cybersecurity threat. Sources say hackers have launched a wave of attacks against some of Wall Street's biggest money managers using sophisticated voice phishing tactics to target internal systems. And for more, we're joined by Bloomberg's market reporter, Anthony Stevens. So what do we know about the attacks?
Yeah, what's interesting is the voice phishing angle to this, right? The new technology allows these attacks to be much larger than they used to be before. Before, voice phishing was essentially just sophisticated impersonation. Now, with the technology, you can have multiple thousands of these calls going out to a range of actors across the hedge funds, right? So it's very hard to secure that human connection. People need to talk to each other to get trades across the line, analyst mentions, whatever, operational stuff. So this new vulnerability is going to be very hard to fix given the sophistication and how closely this stuff can be mirrored. Now, this opens up a new kind of a paradigm where AI is being used not only just pure kind of software hacking, but also on the human hacking side of things, right? So that is a new kind of problem for hedge funds to deal with in the middle of what is one of the most tumultuous months in hedge fund history as the momentum factor unwinds so blatantly. So there's a lot to worry about here.
I mean, it was a tough month. I mean, save for obviously Citadel, but there was a idiosyncratic push there. But talk to us about the tough month. It had been.
Yeah, so the dispersion within the hedge fund universe has started to pick up in a really material way, in a mirror of who gained in the first half of the year, right? So momentum and tech sold off so strongly that, the biggest victims, quote unquote, in July have been the tech funds, which are down around 10% as a group. Now, multi-managers have done a little bit better by just being flat in July, but even they have been impacted by the tech and momentum sell-off. Now, there are these idiosyncratic, as you mentioned, like people who are playing for idiosyncratic or macro opportunities have done a little better, but now you can see from SanDisk and Western Digital digital's earnings, having this knock-on impact today in Japan and in Korea, you can see how positioned people are on the momentum trade. That is going to continue to drive equity returns in the back half as people kind of cut some of these trades to reduce the risk. And in that context, it's very interesting to see situational awareness as a new investment being in the private market, where you have the time horizon, you can hang on to high conviction ideas without these very hard mark-to-market losses.
Also getting burned in the month of July is not just about the pressure that the hedge funds face, there's also the retail investors in South Korea. I mean, does that mean that, they'll sit on the sidelines for a little bit, or how much do you see that coming back?
No, you definitely see this crowding element, right? Like hedge funds and retail have been hunting together more or less in the first half of the year, and they've done fantastically well. Now that's turning across the world, right? Whether you're talking about Kioxia in Japan, you're talking about Samsung or Hynix in Korea, you're talking about the Chinext in China, the margin traders in Taiwan. There's been a big concerted pull back of retail investment alongside the hedge funds. So the most aggressive corners of equity risk taking are taking a bath, and that adjustment will slow things down in the back end of the year until we get new positive catalyst from the AI trade.
Anthony, thank you so much. Anthony Stephens, our markets reporter. Just to continue that thread there, so you have Carlyle posting its strongest quarterly earnings in nearly 4 years, and we'll get to why in a moment, but it sold, of course, more private equity bets. It returned more cash to shareholders. Our colleague Danny Berger sat with a CFO who explained why defense, and to the point we just made, AI, were still among the key themes driving investment opportunities this quarter.
We now do have a specific platform aimed at defense and reindustrialization. And this quarter, we actually did our first deal out of that platform, a company called Secturion Systems, which provides encryption to governments and to government contractors so they can send classified information securely. But this is a long-term focus for us. The focus on national security, on data infrastructure, we see an enormous amount of opportunity here. And so we think there'll be a lot of demand for that type of strategy.
Justin, thinking about that platform, some of the big exits you had, Medline, a healthcare company.
Yep.
These aren't exactly like high-flying AI names. Is that a coincidence, or is that a specific choice that you're making not to really chase after the AI trade everyone else is?
Yeah, when we invest at Carlyle, the core tenet is diversification. We've always been diversified across many different industries. Our power alleys are aerospace and defense, healthcare, financial services, and we found great opportunities to invest in these spaces. But I think it's important to understand AI as a technology, it's not just about pure play AI. AI is going to revolutionize every industry. And if you look historically at technological revolutions, some of the best investments are actually when a company takes the new technology, figures out how to apply it to their specific industry, their specific company, and then jumps to become a market leader because of that. So we're implementing AI. AI is a big theme. We're just not focused on only pure play AI. We're focused on many different industries.
Do you think there is a risk, though, that this industry, and I guess maybe safe for Carlyle if you're not doing it, is getting overly concentrated in AI?
Well, there's certainly a lot of capital demand for AI. And clearly the hyperscalers have put massive amounts of capital there. They're now coming to the private markets to get more capital. But for us as a private markets investment firm, that's an opportunity. If they need our capital, we can be very selective where we put our capital. So is there a risk? There's always a risk, but AI also is going to be transformative, and we're very front-footed about employing it.
The Carlyle CFO speaking with our Bloomberg colleagues. And here's a look at how Asian markets are doing as we get to break. It's still that red on the screen. You are seeing that underperformance on the Hang Seng with the drag coming through from the Hang Seng Tech. We'll continue tracking that after the break. This is Bloomberg. Some corporate stories we're following. Shein said to be planning to start gauging investor demand for its Hong Kong IPO as soon as this week. Sources say the fast fashion retailer may hold so-called pre-marketing investor meetings on Thursday. They say Shein may look to raise about $2 to $3 billion in a listing that could take place this month. Google shares closed lower after AI pioneer Jeff Dean announced he's leaving the company to launch a startup and taking several high-profile DeepMind researchers with him. Demis Hassabis, the head of Google DeepMind, is also moving into a chairman role at the lab. The leadership changes could make it harder for the company to recruit top talent and compete with rival labs amid the AI race. Glencore saw a sharp jump in profits in the first half of the year, driven by a surge in copper prices and strong performance from its coal business. Core earnings rose 86% from 2025 to $10.1 billion. Glencore says it's returning an additional $1.5 billion to shareholders and announced plans to seek a secondary listing in Australia. But we're seeing, in terms of the market reaction, aside from tracking copper, we're tracking gold as well. And what else is happening on the Hang Seng?
Yeah, I think gold's going to be interesting because it's quite few and far between. Of course, we've seen rallies of the sort we've seen in gold. We'll get to that in a moment. But yes, I mean, in terms of sectors, right, gold mining stocks are under tracking, financials, and now property is actually down, and down by a lot. In fact, property is also underperforming now the financials in Hong Kong on the back of that news. Gold spot, bottom of your screens, continuing the best day since Feb. That's going to be playing out across gold-related stocks. Before we get to that, Cathay Pacific's also out, of course. It was out with earnings yesterday, so let's have a look at how that stock is doing at this point in time. So we're up a further 2% on Cathay Pacific. You certainly have a fairly decent clear skies outlook coming through out of the company there. Gold stocks on your screens. This is, of course, the Chinese market iteration where you do have, of course, the biggest names across the region. And it's various ways to play the gold space, whether that's on the mining front, on pure miners like Zijin Gold, or some of the retail exposed arms like Laupu Gold. And this is similar to what we're seeing across the region. In Australia, for example, which we'll get to all of that in a moment. But this is the shiny bright spot today across these markets. Lots more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the Hang Seng half hour into the session. Well, if we can pull out the Hang Seng and how it's faring. I mean, we know how it's underwater, right? We're about 2% down on the index. Yeah. And we know how the property stocks, the financial related names, those are the ones that are getting hit today against the backdrop of some of these tax concerns or the crackdown that we're seeing potentially right from the mainland. So that's causing some skittishness, and not helping, I suppose, is what we're seeing on the tech front on the day where the memory trade is still coming under pressure despite some of the early signs of a reversal earlier in the week. Can momentum come back? What does this mean for the Chinese internet platform names that look like they were making that, staging that rebound?
And then today happened.
Yeah.
Biggest drop on the Hang Seng since March. In terms of market breadth, almost everything is down with the exception of your gold place, which we'll show you in a moment. So the likes of some of the mining stocks, the jewelry makers, the retail place like Laupu and Chow Tai Fook. Apart from that group, everything is down across the tech space, across the tech stack, across the region, and as you can see on your screens, despite, of course, the usual tailwinds in the form of a softer dollar, tighter spreads, and falling yields. Right, just on the gold story, flip the page, please. And gold, as you can see, in spot and precious metals, again, having their moment in the spotlight today. Some of the insurers, we talked about this, very much in focus. Big drop in the afternoon yesterday following that Caixin report, which we'll get to in a moment, continuing to see very sharp drops in the region. We're down about 9% on AIA. Prudential's off 6%. Ping An down 2%. HSBC is also down alongside these names, including StanChart coming up on your screens, ICBC and Bank of China Hong Kong on your screens as well. So on top of financials, property names, which is somewhat related, of course, to what's going on here, also seeing some tremendous pressure in the Thursday session.
Yeah, let's get back as well to the Tyson report that Beijing is closing a key tax loophole for Hong Kong insurance policies. We're joined by Bloomberg's North Asia chief correspondent Stephen Ingles and Bloomberg Intelligence banking and fintech senior analyst Francis Chan. So, Steve, we talked through some of these considerations earlier. I mean, what else are we expecting in terms of the clarity of what this is really about?
Yeah, I think the markets are a bit spooked, like they were in June as well, when there was concern that some of the banks here in Hong Kong were being asked not to open up accounts for mainland visitors. That spooked the market a little bit. Of course, the crackdown on those brokerages that were allegedly doing illicit trades and cross-border flows. So there's been crackdowns on and increased scrutiny on wealth and wealth being transferred across border, and also essentially tax transparency. We do know that Chinese authorities are trying to revamp, and they have been for quite some time, trying to revamp their tax code. What we're hearing from the Caixin Global news report is essentially saying that there are new rules that are already being implemented and enforced. In fact, early enforcement cases in Beijing and also Hangzhou says tax authorities are already levying a 20% tax on individual payouts, dividend payouts, interest earned as well from offshore policies, as Beijing is expanding its personal income tax to include any returns from those insurance policies that mainland Chinese have come across the border to buy. Many insurance companies, whether it's AIA or Prudential, HSBC, and the bank side and others have seen a large increase, obviously, and have seen a great boost in that side of the business. I can get into HSBC in a little bit after Francis and some of the numbers they were reporting, but those insurance policies have been quite popular. Now, the mainland authorities have been able to tax this by law, but they haven't been able to implement it necessarily because of sort of data visibility has been lacking, and just enforcement has been a problem. So this is, again, sort of spooking the market about how far and deep and how are they going to continue to get this 20% tax. A 20% tax would, on personal income from these policies and the dividends and also the returns, would essentially negate any benefit potentially that these policyholders would get by doing it in Hong Kong.
Yeah, I mean, they're fixing the incentive structure. And I'm sure the HSBC folks across the street, if not already, are working out the numbers. But Francis, you've run the numbers on potential impact on HSBC?
Well, it's very hard to quantify any impact given the very imminent nature of the piece of news.
Okay.
Well, we know that there has been about half of the new premiums coming from non-residents for the Hong Kong insurance business. And more than 60%, about 60% of their insurance balance coming from the non-residents, including the mainland residents. So that obviously there could be a bit spooky. But I just want to reiterate, HSBC has been continuously under the common reporting standard, report to all tax authorities globally, including the mainland Chinese authorities. So any information about maybe the income from policies from mainland residents is not new. The information is always there. Secondly, I just want to reiterate there's no sign it is a tightening from what we have already seen. The State Council Order number 837, which has been effective from early July onwards. So it could be an enforcement of existing rules instead of some new set of tightening. And if we take a look at what happened last time in early June, the HSBC Standard Chartered, the share price bounced back right after the very spooky trading sessions.
Overall, though, how do you see this perhaps affecting the outlook for the wealth business? I mean, to a point, we were not quite sure yet what this would mean, but wealth momentum, what is that going to mean? The
CEO of both Standard Chartered HSBC, they came out after the first half results, reiterate there has been no impact or at least a very immaterial impact to the account opening and new fund flows, at least towards the end of the second quarter. And so far what they have seen in the third quarter. So this is a very critical piece of information. HSBC in particular, they have been a very responsible corporate citizen, and they have been always adhered to very strict rules. And those rules, most of them are already in place. Some of them could be refined. But so far, at least from the management, we didn't see any signs of stress, at least over the last news flow, dated back May and June.
They do have a bigger book it's a larger group, of course, than just a pure play insurers. Steve, where do we go from here with the story?
But some of those numbers, and Francis, you can maybe corroborate
go
this.
for it.
I mean, life insurance was among HSBC's fastest growing wealth business, with fee income up 21% in the second quarter. Hong Kong annual new premiums for HSBC was up 26% in the first half. So essentially, you said there's no material impact right now, but I think the market reaction is to this report that says authorities in Beijing and Hangzhou are already implementing this 20% tax on personal income because, as you said, perhaps mainland authorities are already getting the records of who's buying those policies and that tax. So I think this reaction on the market is to the news that policy enforcement has always been the issue, isn't it?
Yeah.
Right? And that's essentially what we're seeing now, right? And authorities have been trying to do a number of different crackdowns on trust products, which has been very popular with the ultra wealthy in China. We saw the crackdown on the cross-border flows for money to come in that maybe exceeded some quotas for IPOs. We've seen a number of crackdowns, or that crackdown as well on the offshore listings for red chips. That vehicle. So this might be part of that, but again, it's the enforcement angle, the 20% levy of these taxes that is really sort of spooking the market again after what we saw, the spook that didn't last very long in early June.
What do you think, Francis?
Totally agree. In fact, there has been some market views overnight talking about the focus could be on the ultra high net worth individuals, family office, like the tightening on the trust income. Of course, the same market view is talking about maybe it doesn't affect the mass market as much. That's the first point I want to make. The second point would be about the interest rate differential between the policy in mainland China and Hong Kong. In Hong Kong, there can be many US dollar denominated policies. Those are running at US rates, and the Fed may have rate hikes, through the 2027.
Sure.
And the spread has been existing for a while. And of course, a 20% tax on those policy returns could be a hit. But even if you deduct that 20%, there should still be a spread. I just want to reiterate that point.
Okay, so what is the message, Francis, you think, for two separate groups of people? What do they need to be taking away? For investors in these financial institutions, so shareholders of HSBC, Prudential, what do they need to be thinking about? And separately, wealthy people, what's the takeaway for them?
Well, I think for the banks, they have been constantly having dialogue with all the regulators, all the authorities. So, is it to their surprise? I doubt. And they might have countermeasures, or they might have imposed whatever measures to make sure business will be run very smoothly.
But I think the concern is, does this impact onboarding of new clients, which these banks have been doing?
Definitely. I also do my market chatter, and some account opening has slowed down. Not for the two banks we just talked about, but for some other banks in Street. Agree that could be the case. So new flows, there has been some concern about the slowing new fund flows. But at the same time, the base is big enough. We have investment return, and we still have the local new fund flows coming in, and the fund flows from elsewhere. And mainland tape has not been shut down. There may still be a good portion of those coming to Hong Kong, the compliant ones. So for the investors, I think that's my short comment. For the wealthy individuals, I think they have many cars in the sleeves too.
Okay.
I just won't want to go into that topic.
Yeah. Okay. Yeah. There's a Bugatti and a Ferrari in the garage, right? Why worry about the Camry? Okay, guys, thank you so much, gents. Fantastic. Thank you so much. As we got into that, almost got derailed there. Stephen Engel. And of course, Francis Chan there on many sides of the story. Okay, as we were just having that fairly lively conversation, DeepSeek is out, and this conversation on pricing, it's looking to raise some overall pricing here.
For API services, so it looks like it can set prices.
Pricing power.
Yeah, this is exactly what investors want to see among the AI model developers, right? And whether it's for tokens or, something to step in the right direction when it comes to monetization. And of course, I think we'll continue this conversation with the AI read-through in terms of what this means for maybe data center investments as well. So coming up, we'll be speaking with JLL's Pamela Ambler on the firm's latest Asia-Pacific capital tracker and what it reveals about investor appetite for commercial real estate across the region. This is Bloomberg. We're taking a look at Minimax and Zhipu as well, following on from this DeepSeek news that they are raising prices for API, right? The pricing power, that's really what we want to see. That is coming through, I guess, in the market reaction. You're seeing the double-digit gain on Minimax as well, but perhaps this is also the other layer, the southbound inclusion when it comes to this AI developer. Zhipu, of course, the other one on the other side of the screen, you're seeing those gains loud and clear on a day where if you look at the Hang Seng Tech, the Chinese internet platform names are not doing terribly well. So you're seeing the likes of Baba, Tencent, the old names. Those are the ones that are coming under pressure. So it might take a while for them to do that rebound. But also when it comes to two sides of a coin, I suppose.
Yes.
There's been this online debate on the value of appreciating the yuan in a bid to fix global trade imbalances. Former IMF chief economist Gita Gopinath said while the Chinese currency is undervalued, calling for a revaluation would only get, quote, the diagnosis and the cure wrong. And she, along with former IMF colleague Pierre-Olivier Gourinchas and London Business School Professor Helene Ray, have argued in The Economist that China's surplus reflects weak household consumption, currency appreciation could worsen deflation without rebalancing trade.
And on the other side of that argument, in case you miss it, it's gone proper long on X and Twitter. Michael Pettis disagrees. Well, they both agree on the valuation of the currency. What will revaluing it solve is, I think, their sticking point, and that he thinks that if you appreciate the currency, that remains one of the most direct ways to reversing some of the imbalances like domestic income that then generates a trade surplus. And I think this goes to the crux of the issue is when you have efforts to rebalance the economy towards consumption and you have this resurgent export machine, and it's not just the Chinese side of the conversation, right? You're seeing that in many parts of the region. Taiwan exports, Taiwan GDP, you look at South Korea and you look at Hon High Precision and the sales that they're seeing. You look at the yen, for example. So this really gets us into a lot of very topical things this week.
Let's bring in another voice on this so it's not just the two of us, right? Also in red, Johanna Chua, head of emerging market economics at Citigroup Global Markets. So, Johanna, we've just kind of run through the two sides of this debate when it comes to the yuan and how it might be, with appreciation, helping to deal with some of these trade imbalances. Where do you sit on that?
Look, there's no question, there's no doubt that yuan is undervalued. It's a question of, is it undervalued? Is it a cause and effect? Is it the main cause of the undervaluation? Is it the main cause of the global imbalances and therefore appreciating it would solve all the problem? Or is it partly a consequence? Because part of the reason why it's so undervalued is because inflation differential in China relative to the rest of the world is much lower. Obviously we've got much more subdued inflation. That's actually further exacerbating the undervaluation. And that may be a symptom of structural policies. The fact that you're having policies too skewed towards supply and industrial policy and investment rather than supporting consumption. So it's a question of what's the best way to solve this? I think, where I have a little bit of sympathy with, some of the arguments that Gita has said, it's like discussing about the renminbi and saying that's a solution. It's almost like it's dead on the water. It's not like the Chinese authorities are going to respond and say, okay, I'm going to revalue the currency and that will solve it. We can debate all we want. There's more policy there's more progress that could be made by convincing China that really the structural imbalances in the policy of both too much investment vis-a-vis consumption, it's in their best interest. If you go about it addressing the imbalances in the economy and consumption and investment, which, by the way, I think even Chinese authorities also recognize some merit to that, you can get further than just saying, we're just going to revalue the currency, because it's not going to happen. It's almost pointless, right?
That's a good point. I mean, at the end of the day, practicality needs to reign supreme. But I guess from a policy perspective, markets are trading on China they're doing well in advanced manufacturing. Consumption isn't coming back. And I think that's where the currency comes in, right? Can you achieve both at the same time when you hear the Politburo saying we want to prioritize advanced manufacturing and technology, but we also are aware that the consumption story remains
and
quite
the solution
soft.
The solution to a consumption story is not a big revaluation. I mean, part of the solution is you really need to boost policies towards boosting household income. And, that really has to do, there's no easy fix to that, right? You really need to either expand the welfare system, kind of provide more policies to support transfers to households, more policy support, again, a kind of a broader spectrum of policy support. I think renminbi appreciation alone is not necessarily going to solve all of that problems. Because again, it doesn't mean that people are going to respond to that and just suddenly consume. And then the question is, there's also the worry about whether it will exacerbate deflationary pressures. I do think that's a bit exaggerated because a lot of consumption now in China is increasingly less import intensive. It's more domestic. So the deflationary impulse of a big revaluation, it's not clear how big that will be directly. But I do think that, it's really a broader story about policies. And unfortunately, I mean, we just had the mid-year Politburo a few weeks back, and that was kind of a non-event, right? We had not a few weeks back, just recently, last week. We had the mid-year Politburo meeting, and I don't think we really got any kind of signs of any major policy pivot. They're strong on rhetoric, but in terms of actual policy action, the way they want to address consumption is still more towards the supply side, improving the provision of public services, rather than any meaningful policy pivot on the demand side through income support. So that's why we still have this dilemma.
So what exactly do you think, if you were to advise policymakers, what should they be doing now to try and boost consumption then?
Well, look, it's not an easy fix. It's a very, very broad set of policy. But of course, partly you really need to reduce some of the precautionary savings of households. Part of that is really expanding social safety net. Part of that is to allow more provision of public goods for, a lot of rural migrant workers, this whole hukou system. I mean, they're already trying to do that, make inroads so that rural migrants have access to public services in the urban areas so that they don't have to save on education, medical, etc. So equalizing a lot of the treatment. A lot of that is really structural reform. It's just very, very difficult. But again, really more proactive policies of providing more consumption transfers, including benefits for unemployment, for, aging, social welfare, health. But again, it's not an easy fix. This is going to be, it's going to take time. Look how long it took Japan to kind of gradually rebalance consumption. And I think obviously that's going to be a big issue. It's hard to imagine that will happen because we're still in a strategic competition with the U.S. and China is still putting a lot of priority on achieving some of these technology self-sufficiency gains. And in that essence, there's still this bias towards more supply-side industrial policy. And household savings are a convenient tool to provide cheap access to credit and liquidity to fund those incentives.
Yeah, it's a matter of priority, I guess, at this point in time. Since you brought up Japan, the yen's also been topical.
Absolutely.
Is that, though, an economic... two things. Is that an FX issue? Is that an economic issue?
So first of all, the way we look at this whole joint intervention on FX and the participation of the U.S. Treasury, that's really primarily not because the U.S. thinks the yen is... it's really the incentive to weaken the dollar yen. I don't think the FX was the objective. The objective was to preempt or to prevent any significant kind of Treasury sell-down intervention by the Japan, which could destabilize Treasury market. So that was really the incentive, is to preserve stability in the U.S. Treasury market, then really specifically on an FX objective. Of course, the reality is, I cover emerging market countries. These type of intervention, FX intervention, capital flow measures, the lesson from emerging markets is, okay, that helps in the short term, but it's not a substitute for really macro policy adjustment. And of course, one of the big fundamental adjustments is we need to have probably faster pace of monetary tightening in the BOJ. The market is interpreting BOJ being behind the curve, and that's showing up on FX risk premium. Yeah. So you do a little bit of stopgap intervention, but the question is, where do we go from here? Now, there's a lot of debate. Maybe the U.S. will broaden out the tools that Japan can use. So maybe expanding the FEMA facility. We don't know, right? But in the end, I do think, in our view, and this is, our rate strategists in Japan had written about this, the view is this intervention by the U.S. is probably going to pave the way for faster normalization of BOJ policy rates towards, instead of, our base case right now is 1.5%, but our rate strategist is saying, it can go to 2%.
Okay.
No, I was just going to follow on that train of thought because I think it's interesting. If this is really about treasuries, one of the points that the IMF and co are making is that developed economies need to fix their fiscal deficits, not focus on doing that through currencies to help the trade imbalances. Johanna, good to have you. Thank you so much for your time. Johanna Chua, Head of Emerging Market Economics at Citigroup Global Markets. Let's take a look at how Asian markets are doing as well as we head to break. Today, it's really the tech sector that's getting hit, whether you're looking at the Kospi or even in Japan, as the memory trades face that continued pressure. Even the Chinese internet stocks are not getting spared today. Model developers, those are going in the other direction. We'll continue tracking that. This is Bloomberg.
Right, the long memory trade is peeling off even further today, and I think what's interesting too is you have the likes of CXMT also joining in on that move lower, really on the back of the news call we had overnight from SanDisk and Western Digital and the reports there. Property stocks are also seeing some pressure right now, as you can see on your screens, and of course the other bit is these new inclusions in the Stock Connect, Luxshare, CTCC, and Minimax. All feeling this, perhaps more with Minimax. We have lots more ahead. This is Bloomberg.
From my understanding, it was a truly significant initiative, the first in 27 years. In terms of the currency, it could buy some time, but it could end up being just that, unless the fundamental economic situation and the broader environment doesn't change. Since such a landmark action has been taken, fiscal and monetary policies need to be implemented. I believe that is what is most important.
Japan's former Prime Minister Fumio Kishida discussing the impact of recent currency intervention on the yen. And as Japanese markets go to break in a couple of seconds from now, we are, of course, watching out for some of the commentary that's come from the Japanese leader, Sanae Takaichi, speaking in Hiroshima, talking about the return to that 8% food sales tax and how this is something that's needed for market trust. She also spoke of the benefit of this new tax credit system and how that would actually exceed the tax cut. Of course, that is the chosen modus operandi from the Japanese policymakers in terms of helping to buffer from the impact of the weak yen and then the energy costs as well that, in some ways has been going up and affecting Japanese consumption, I should say. This is coming at a time where if you look at the fundamentals, one of our colleagues, right, Garo, already talked about this. When it comes to the yield gap between Japan and the US, that's actually been narrowing. So it's interesting that we're still seeing the yen on the back foot. Of course, this has meant that, the US, Japan, they've had to step in.
Right.
To intervene. To what extent is that because of not wanting the pressure to come on treasuries? That's another question. And of course, this is all having read through given how we've been talking about this, right? The treasury pressure that's coming at a time where the concern is really on the long end, the concern about the lack of visibility, I suppose, from the likes of Kevin Walsh. So all this in the mix as well. And of course, we also have earnings when it comes to some of these Japanese stocks.
I was about to, I almost forgot. So tomorrow is the busiest earnings day in Japan. Well, today and tomorrow, certainly. And, first you got to wonder what the fundamental story looks like if you strip out the yen effect to a lot of the multinationals, right? And I think the yen's become more complicated an issue and how they really frame that and what their assumptions will be. I think it's going to be interesting to watch because of how much that's changed just in the last week, right? So what are their FX assumptions? The other thing, too, and I think this is interesting on the bit we're getting on not memory. Can we show our viewers, by the way, this line that's come through there on the sales tax? Because I'm racking my brain when or if they remove the sales tax on food. I think the reason I think that's relevant is it was back when they implemented the sales tax, which you can reimburse, right? When you go to Japan, you do some shopping, you can, for tourists and non-residents, you can get that back. It came at a time when people were worried about the Japanese debt burden. And I think those fears are even more pronounced today than they were when last time we had this sales tax conversation, because you have yields currently at the current levels. And I think, this is my speculation, judging by how that headline is phrased, to regain the market trust is they need to come up with the credible solutions on the revenue side of things, right? So let's see whether or not this is something that they will be adding to the tax revenue toolkit. If it is something, I think that's going to be a massive story. If in fact, let me just hedge it, if in fact that is where they're headed towards in terms of introducing a new sales tax. Again, I'm not too sure where the conversation is around the 8% food sales tax.
At least we have that conversation on earnings to bank on.
Yes.
With SoftBank.
Oh,
right?
yes, we have to get to that now. Yes.
Yeah.
Okay.
Well, we're going to get those first quarter earnings out of SoftBank soon. Investors will be looking for those signs that its bets on AI is paying off. Our Bloomberg Japan tech reporter Min-Jong Lee joins us now with more from Tokyo. So, Min-Jong, what are we expecting of June quarter results, and specifically, these investments that it's been making into AI?
We're actually in a place where things could swing very easily, very quickly to one side and the other. And this is because SoftBank has a lot of AI and tech assets. And as you know, markets have been very volatile, with share prices moving in big ways, very sharply up and down. And these moves have a direct impact on SoftBank's investment P&L. And one key asset, of course, is OpenAI. And for this quarter, OpenAI's valuation is not expected to have changed much, having a neutral impact. On one hand, chip assets are expected to have outperformed, namely Intel, whose stocks shares rose more than 200% during the June quarter. But still, even so, Vision Fund may have logged losses because of its performance on some of the assets, including PayPay, which listed in March. And PayPay shares are expected to have fallen more than 30%, having a negative impact. So it's a mixed bag of things. And of course, we'll have to actually see what the numbers look like when they're disclosed later today.
Okay, so Min-Jong, what should we be looking out for as far as guidance is concerned? So, they'll be reporting something, they'll be telling us something about the future. On the latter, what's critical?
Right. There's a lot of things to look out for, but the key thing is SoftBank continues to be highly exposed to a lot of AI and tech-related assets, and now we're in a place where it's very difficult to anticipate what's to come. And Masayoshi Son has a lot of big AI projects in the works. This includes one on robotics. SoftBank has been buying up a lot of robotics tech and startups. One other thing is, of course, data centers. SoftBank is now involved in big data center projects, not just in the US, but also in France. And there's a huge amount of interest in how SoftBank plans to finance and develop its 10 gigawatt data center project in the US, potentially with multiple off-takers, including OpenAI. So there's lots to watch out for on what Son has to say about all of these going forward.
Min-Jong, we'll watch that earnings scorecard as it rolls through. Thank you so much. Our Bloomberg Japan tech reporter Min-Jong Lee in Tokyo. And coming up, we're talking about property.
Yep. Our Anthony Stephens' favorite topic, Hong Kong property. He'll get a kick out of that comment there. Pamela Ambler will be joining us. We're focused in on commercial property here, industrial office space. It's been an astounding quarter in terms of volume and sales and activity that's taking place. So against the backdrop of higher interest rates, how do you square that circle? What happened there, and does that continue? That's coming up next. This is Bloomberg.
All right, we're taking a look at the commodity gold because it has bounced past the 4,200 handle. You're now sitting closer to 4,300, and this is also dragging up along with it some of these gold-related stocks in China and Hong Kong, and is following on from the precious metal extending its biggest gain in 6 months. Some of it is the progress over the Strait of Hormuz and helping to ease concerns on the Federal Reserve related to hike expectations. Bloomberg's metals reporter Yihui Xie joins us now. So Yihui, talk to us about what you think is behind gold's biggest jump since February.
As mentioned, the macro news definitely is an important tailwind. So we have some kind of an accord nearing completion over the Strait of Hormuz. So I think that definitely is an important factor because we see that precious metal had been under pressure ever since the war started in February. But I think another important factor to think about is also the technical support. So we see gold breaking through the 4,200 level yesterday, which was the highest ever, since February. So I think that also drives a lot of momentum inflows into gold over the past 2 days. Another factor that we need to consider is also that gold has been consolidating at the 4,000 level over the entirety of July, and for that I think the Chinese investors have been extremely important because we see the consecutive inflows into the onshore exchange traded funds, which shows that the institutional investors are really buying in at the 4,000 level. So I think after that period of consolidation, people are getting a bit more optimistic and not sort of following through the downside that we've been seeing over the past few months.
Okay, what's the next level to watch then? Are we looking at 4,500, 5,000? Some folks had, I would remember at one point, 5,500, 6,000, but it seems that boats sailed.
I think that might be too early to call. I think we are still in very much a high rate environment, and people are still pricing in a rate cut for the end of the year. So I wouldn't call sort of resumption to the rally that we saw last year. But definitely, this is a relief rally after the gold had been a little bit underpriced over the past few months. So I would say it is not a full resumption, but rather a short rally. And we will see how it goes.
We shall. Okay, Yihui Xie, thank you so much. Our metals reporter on the gold's biggest pop, daily pop, since in about 6 months or so. Okay, from that, let's head the opposite way when you look at pricing across some of the property counters here in Hong Kong. So I think this really is the underperforming group. We're off by about 3 and a fifth of 1% on the benchmark, on the subsector benchmark itself, as you can see individual names on your screens. That takes us into our next topic.
Yeah,
nicely,
we're talking
nicely
about commercial real estate, to be specific, right? JL saying that APEC has seen the strongest half-year volume on record in commercial real estate investment, and it came in at $92.5 billion despite inflation, despite geopolitical uncertainty. Joining us now is Pamela Ambler, APEC Investor Intelligence Head at JLL. Good to see you.
Good to see you. Thanks for having me.
So, strong investment numbers. How much of this is from a low base, though?
It's not actually. Actually, the last 3 years, we've seen consistent momentum and growth in terms of transaction volumes. To some, it might come as a surprise because you think, wow, there's a lot going on in the macro environment. But if you look at the overall just deal-making environment, you think about M&A, you think about venture capital, you think about the IPO market, there is so much activity. And part of that is attributed to the fact that there was a lot of dry powder that had been sitting on the sidelines over the past few years with some of the pricing adjustments that have occurred, with some of the events that have played out. You begin to see a lot more confidence in terms of deployment. Yes, there is the rate environment that is uncertain, but I think investors have been waiting on the sidelines for long enough.
So who's spending the most money? Like, who are the big spenders? And does that source of, does that driving source continue, I think is my question.
Yeah, absolutely. So in the commercial real estate in Asia Pacific, we are seeing anywhere from pension funds, sovereign wealth funds, private equity groups are in particular very, very active. Okay. You talk about the M&A activity, you see it in the real estate space too. You see take privates of REITs, you see acquisitions of real estate development firms by private equity as well, activist investors unlocking companies that might have assets that sit on the balance sheet that are grossly undervalued because it's not part of their core business. Right. And cross-border as well as intra-regional Asia-Pacific capital have all been part of the equation.
And what about AI as part of the equation? Because, I mean, I think JL has been focused on Japan for quite a bit, but what about China as well?
Yeah, absolutely. So I think that's the bright spot when it comes to AI. That's probably the number one question we're getting asked right now when we go see investors is what is the impact of AI on commercial real estate demand? Because there is a big concern about the displacement of the labor force and automation. So what we've done is we've looked at three components. One is the augmentation of productivity. Two is basically that selective displacement that takes place. But then the third one is the new job creations as a result of the way companies operate. And we're really beginning to see the net of that is that office jobs are going to stay relatively at the same level.
Are there certain sectors that stand out in terms of, assumptions around the growth of the workforce, for example?
Yeah. Well, so IT, unfortunately, that is the sort of sector where we're seeing the most amount of changes, right? Because there is a lot that can be done by AI that is a lot more efficient. But then you also need people who have new skill sets that can accommodate. For example, off the back of AI is the advanced manufacturing boom that's taking place. Yes. And that is, partly supporting the logistics transactions and story that we're seeing, in addition to, of course, the recreation of the supply chain as a result of tariffs.
What about how investors are positioning given the concerns surrounding the Fed? You alluded to some of this a while ago, but there seems to be less visibility on the interest rate trajectory. How is that affecting investor decision making?
Yeah, that when it comes to the underwriting, right, there is a lot of considerations for where ultimately the cost of debt is going to be or where the bond yield is going to be. Most real estate investors look at the 10-year as a benchmark. Yes, when it comes to looking at these factors, there might be scenarios in which you have a best case, worst case scenario. But where there is more certainty is we're seeing more hands-on operational beta generation. So one of the things that we discussed is when it comes to a core strategy, for example, the definition of that has changed over time. In the past, when it's an income-generating stabilized asset, that would be good enough. But now even the core assets or core strategies would consider improving your the operation of an asset, sweating the asset. It takes a lot more attention and detail. And I would say that the investors nowadays are a lot more discerning than they were a few years ago.
Sweating the asset, I think that's the first time I've heard that. So our expectations then for returns, have they been bumped higher at this point in time? If it was just income before, there's a lot of visibility around what you can get for income, but help us understand changing expectations.
Sure. So on the capital value side of things, one of the markets here where we're sitting is we're beginning to see a bottoming out of not just rent growth, but also in terms of where we're going to see capital value moving forward. We forecast those for every single market, and there is a healthy amount that takes place. So even when you have certain elements that are uncertain and yield, whether it's expanding or compressing, you have enough of the strong fundamentals. And that strong fundamentals is not just the demand side of the equation, which very much exists, but the supply, the increasing cost of construction, that is across every single sector. And we look at the future pipeline of supply for office, logistics, retail, there is a significant drop off.
Second half, this current half, will it be as good as the first? Just your initial take on what's going on so far early on.
We do believe this has a bit more time to run in terms of the amount of capital activity taking place. A part of it is also looking at the future of capital. So the creation of some of the pension reforms that are taking place in other parts of the world. You see large amounts of capital creation or formation, and those need strategies that deploy into alternatives, which real estate is a big part of.
There we go. Alternatives keeps coming back. We managed to avoid
Maybe we
it up
should
until
look
Thursday,
into
and then here it is.
Look into the alternatives.
Careers or just investment?
Let's have a chat outside of
Yes,
this
I don't
show.
think we should have it on
not
live
on
TV.
air.
Not that there's
today, at
any
least.
conversation to be had. Pamela, thank you so much, by the way. APAC Investor Intelligence Head there at JLL. We'll have plenty more ahead, not that, but we'll have something else to talk about on the other side of this break.
Continuing that conversation on career paths, I think. Part of it, tangentially.
Where do you want to be based?
Yeah.
Low tax environment, very dependable transport system. Terrible weather, though, recently.
No, it's been sunny this week.
Yeah, I'm being generous with that. But
anyway.
since Tuesday.
Anyway, we're talking about how the city has been seeing an influx of white-collar professionals, and this is thanks to...
We're talking about Hong Kong.
We're talking about Hong Kong.
In case it's not obvious, yes.
Yes.
Yeah.
Thanks to this booming IPO market, thanks to planned tax breaks, its expat population hollowed out, right, after those COVID measures and Beijing's tightening grip over the last few years. Bloomberg finance reporter Denise Wee joins us now. So talk us through, Denise, what's driving this influx of foreigners to Hong Kong?
Yeah, sure. As you said, IPO markets are booming. There's a real rebound in activity in capital markets, and therefore this leads to more job opportunities. There's this tax. Hong Kong's always been known for low taxes,
right.
But they proposed this bill to give tax breaks to hedge fund managers, which is looking like it'll go through. So there's a lot of interest around that. And generally, wealth flows are back. So it feels like the momentum of the city has picked up in terms of wealth, investment banking, and now competitiveness around tax breaks.
And rents,
rents.
Residential rents are just through the roof as well,
Yes.
which is indicative of the underlying expat boom. But how different is this current expat boom from previous iterations of it over the years?
Yeah, I think it's interesting because Hong Kong's demographics have been shifting. And yes, we are seeing these expats increase. We've seen employment visas double from the lows of COVID about 5 years ago to now about 30,000. But, we have to keep in mind that for mainland Chinese, increasingly, their numbers are increasing.
Yep.
And, for the approvals we've seen last 3 years, about 3/4 have been for mainland Chinese coming through top talent programs and various other schemes. So, all this is shaping job opportunities. So while, there is a return to expats, increasingly, they have to be quite selective. It's not just anyone can rock up and get a job. You kind of need to have some skills, And if you don't speak Cantonese or Mandarin, it will be tougher. So I think we have to look at it from that lens. Yes, there's a return, but also, you just, not just anyone will get hired.
Yeah. Don't lie on your resume, I think, as a start, right?
Barriers to entry to Hong Kong.
Yeah. Different barriers to entry this
Yeah, okay.
There we go. Denise, thank you. Fantastic. You can check out their piece, by the way, that's on the terminal. It's also on the website. Our finance reporter there. And speaking of Hong Kong, check out our edition of the Hong Kong edition newsletter. Should be out, in fact, any time now, if not already. So whip out your phones, QR code on your screen, scan that, and get it straight into your inbox as well. So I do recommend that, of course. Bit of bias included there. But yes, check out these markets as we look at this, continue to track the fallout, of course, of the Taishin report.
Yeah, fallout is right. You look at the likes of AI. These were pretty high-flying financial stocks, right?
That's
Just
right.
the turnaround, the violence in which we're seeing it on a day like that. There, I use the word violence, actually. Maybe something else. Pressure.
Well, quite a bit of it was a violent swing to the upside, right? In fact, up until a few days ago, you look at some of the technicals on this, right? We're really exhibiting overbought signals, and then perhaps you add to that you now have a reason to sell on the back of some news flow around this, right? You do understand why it's a fairly violent move to the downside.
The move is more pronounced, obviously, on the insurers than it is on, say, the banks.
Right.
To the point that some of our colleagues were making earlier. In terms of some of the other movers, take a look at what we're seeing in copper stocks as well, on a day where, if we can flip the board, take a look at how you're seeing that green continuing on through some of this as copper hits highs. We've been talking about gold as well and how that's dragged up some of these gold-related stocks in the region. On a day where, if you look at the Hang Seng, I think we are still getting that drag. We're, of course, not just tracking finance or property, but also the tech-related names. A bit of a rough day, I think.
It has been.
Fair to say.
Yeah, we started out the show by talking about the momentum being back, but I guess that's the nature of these markets. That's it from us here today. We'll see you all tomorrow. This is The China Show.